Hey guys, welcome back here on Alpha Trading. Today I'm going to show you a strategy explicit from smart money to get payouts prop trading. So it will be very interesting because many retail traders get fished out by the big players. So yeah, it's a strategy where you can also avoid getting stopped out, and also you can position yourself with the big players. So you always have a high risk reward ratio, and the hit rate is also very good in the strategy. Also, it is very easy to learn. There are 4 or 5 steps you only have to do to get very good trades. So I would say let's start with the video. So the first step to make our strategy work is that we have to identify a range. So a range is also called a sideways phase, and it's recognized by the fact that the swings no longer break the highs or the lows. So we haven't a trend, or we don't have a trend anymore, and we form 3 compartments. So the top, middle and bottom. And we also say when the prices are on the top edge of the range, the price is also very high or expensive. And when we are on the bottom edge, so on the low edge, where there isn't many volume, the prices are very cheap. So it's very good for buying on the bottom and very good for selling on the top. So if we look what makes a range or a sideways phase very work in a specific way is that we have those 3 compartments. One is the middle, so where prices are balanced or fair, even sometimes or most of the times the POC, the point of control, where the most volume was traded, is also always in the middle. So you always have to find the prices which were declined or not accepted in the middle. And as you can see here, sometimes the price bounces up and down from these prices here. So to find the middle is always a bit easy, because you always have a point where you can see that the market reacts a certain way. So also to identify the bottom, you can look what the chart did. So in this specific example, the bottom of the range would be here, because this exact point here, down here, was just traded one time. So it isn't a price which is very interesting, because the market did just get there one time. So yeah, it's very important to see the price react many times. And also here, this price here on the top isn't also a perfect price like down here, because here the market just did get traded one time. So I would take this at the top, and as you can see, the distance and the width of the zones are always the same, or should match a symmetrical way. So the mid and the bottom, the distance is both are the same if you take it like this, and also the width of the zones are all also similar. So this is very important, how to recognize a very good range from a bad range. So step number 2 is to identify if there's a breakout or if it's a fake out. Prices above and below the range are very expensive or cheap, like I said, and at this point it is deciding whether it will be a breakout or the market is going to fake. And we have to wait for a scenario like this, in this example here. So the price closed under our bottom zone. So here in this example, our bottom zone were here, or is here, and the market closed under. So in this example, we have here a breakout setup, which indicates that the market's gonna fall. And also, oftentimes when the market is going to close, so the period in this time frame is a 5-minute chart, so all candles are 5 minutes, and if the market closes down under, oftentimes or many times the market will also do a breakout, like in this example. So you have really to wait until the market goes under the zone, so in this example under the bottom, but also you can say, yeah, if the market goes here above our top zone here, this is the interesting part. So we have to wait that the market is leaving the range, so that we can do our strategy. The third step is that we have a fake out, and this is where it's gonna get interesting for us, because we are and we will be trading this fake out. So if we look again at a range, so this is another example where the market didn't do a breakout under here, under the range, but instead it accumulated a bit. So the market, as you can see, got here, and many retail traders always put their stops under the lows. So in this zone here, there are many retail traders, many who bought here, here, or here, for example, that put their stop loss under the wicks. So that means that they are going to get stopped out, and to get stopped out when you bought, you have to sell market. So many retail traders are going to sell market in this zone. So this is a very interesting opportunity for the big players to get very much or many liquidity for their position, so they can really get a position which is very unfair because the price is very cheap, and also with many volume because many retail traders get stopped out. So they have a very big advantage because in a quick time they can put in many orders to a very good price. So this is the logic behind the strategy. Also, you will have to wait that the market is going to close in the range again. So we left the range and we are leaving the range in this example, but then when the market comes back and closes in the range again, this is when it gets interesting for us, because this is a sign that the market is gonna trade through this entire range. So we have an 80% probability that the market is gonna trade through that entire range. So the most important zone in this scenario is this bottom range, or this bottom zone from our range. Everything which is traded down here isn't very interesting for us. We will look a bit into the order flow later, what we are gonna, or what we want to see, if it's a breakout or a fake out. But the most important thing is that if the market isn't really short, so if the participants are really gonna want to make the market fall, the market will not close in the range again. So it will reverse on this edge here and will not close in the range and not do moves like this. So this is very interesting and important to know, that if we have a range and we are leaving the range, the most critical part or the most important zone for us is really the bottom zone, and we really have to look up what the market is going to do. So the price will usually fall in the direction it broke out to. So, but if this is not the case, the collects and returns into the zone. So the liquidity, the retail traders get collected their stop loss, and so he has been fishing. Now step 4 is the entry, and to make the strategy work, you really have to adapt the technique that you use the swings to get a really good entry price. So you have to buy really cheap, and your stop loss in this scenario really has to go under the wicks, because it's a logical thing. So in this example, I will show you quickly. We always have the swings. For those who don't know what a swing is, it's just green or red candles changing the direction. So if we have a trend, a swing would be like this, and every arrow would be a string in this example. So because we don't have a swing or a trend in this scenario, we will have to look what the candles and what the structure is down here. So if you look up, the swings are like this because the highs get not broken out, and the lows always get broken. So you can also, as a quick tip for you guys, you can also use a tick chart to identify the market structure a bit better than in a candle chart 5-minute period. So a tick chart is also very helpful for many, because it's very just showing you the price and how the price developed through the time. So as I told you, the swings are always the green and red candles, and in this scenario we broke the swings above here. So this is a very interesting part. So we see that the market closed in our range again. Here it closed in our range again, and then it also changed the market structure. So we don't have a lower low, which means that we always break the lows. No, at this point we are changing the market structure to a higher high. So it means that now we are always building up higher highs until this point here. But what is very important, or what you should know, is also that your take profit has two options like your stop loss. So in this example, our entry would be up here. So over this swing here, this would be our entry, because we re-entered the range and we closed in the range. So we have an 80% probability that we will trade through the range. And then we have two options. Option number one is that we put our stop under the active swing. So the active swing who broke out or who got the high broken, or under the point where all the stop got fished. So we have two opportunities or two examples where you can put your stop loss. And also for your take profit, you have two scenarios where you can put your stop loss too. So because you know that we have an 80% probability, you have option number one is your 1/3 of the range on the top. So your old top from the range. So we have like the three compartments that I showed you. So first take profit could be the top of the range, and also like in this example it got hit here and here. So you had 2 times to react on your top zone. If you are a bit riskier trader and if you think that your smart money understanding is good enough that you can also say, okay, now I understand where the retail traders got stopped out and why the big traders got the liquidity and what they're gonna do with it. You can also get or trade from liquidity to liquidity, because down here, like I told you, there is many liquidity laying here, and so the big player wants also to get out of his position, and to get out of his position he needs again a price where there's many liquidity, and also a price which is very high or expensive, because retail traders normally always get stopped out where the price is cheap and where the price is expensive because of this scenario, so that the big players can liquidate their positions. So in this scenario it would be logical, and in many scenarios it's logical to get from here where the liquidity got grabbed to over here where also the liquidity from all the guys who got short here, here and here and here always get stopped out. So it's very interesting. You can also say, yeah, the first take profit could also then be here. So take profit number one could be here in the top compartment of the range, or even over the highs. So and these are the two options you have for your take profit. And in this example, your entry would be here. And this could be stop loss number one and this number two. So as you can see, even if you take a big stop loss and a small take profit, your risk reward ratio is even 1.5 to 1. So you have less risk than you can get. And if you change the example so that you say, yeah, okay, I will be getting out just over the tops here and my stop loss is this, you can also see that the risk reward ratio is very high. And the hit rate is also very high. You can research this. We have in Germany, what we are doing is that we are trading many smart money traps, options and strategies, which I will show you also in the next video. So leave a like and subscribe if you want, would be very helpful. But what I'm saying is that you can adapt your stop losses and take profits in a certain way that your risk reward ratio even becomes even better. And with a high probability setups like we have in this one, in some cases up to 80%, and which is enormous for this risk reward ratio, you can always have the two very best or very much important statistic in the green. So I told you I'm going to show you what we want to see in the order flow. So order flow analysis is also a very interesting and important part trading futures and trading smart money, because we want to see what the big players are doing. And with the footprint chart and level 2 data, we can clearly see that. So there's the DOM, order book, footprint chart, many tools that you can use, and that I will also show you how to use them. So but first off, let's look a bit up into what we're gonna want to see. So a breakout is usually characterized by an increase in velocity and good auction quality. On the other hand, we usually have the opposite with a fake out. So it's a logical thing, because when big players want a price to break out, they position themselves before the breakout. So it's logic that before the breakout even there are big orders. So velocity means order size, the faster velocity even of the orders coming in is getting higher and higher, and demand is getting more aggressive. So in this example, I showed you, or I opened the footprint chart from the stop fishing also in this example. So this candle here indicates this candle, but this is a footprint chart with our level 2 data. We don't see the numbers in here because on this page I couldn't get or couldn't fit it in. So yeah, which we see here is that the stop losses are getting triggered here and here because, as I told you, many retail traders put their stop losses under the lows, and we have many lows here. So in this region here, so in this zone, there are many stop losses and many liquidity for big players to position themselves very cheap. And in this example, we also see that. So what got played here, so the play that the retail traders got tricked out, is that the market had an unfair candle which didn't even have a wick up here. So in this candle, there isn't, or there weren't liquidity. They didn't create liquidity in this candle. So they only push the candle with the bad auction quality down here, which you can see because here isn't much volume. And as I told you, the breakout, if it's really going to happen, and if big traders or institutions want to get a breakout, they position themselves before. And in this scenario, there isn't much positioning before. Then in down here, so under the half of the candle here, there are many stop losses, as I told you. So many stop losses got triggered here, which we can clearly see here. We see many aggressive sellers coming in, the delta change really in the negative, and it's also very important. I couldn't fit it in here, but I will show you next time when we are going deeper and deeper, and my English gets better too. So yeah. Also, the next zone got hit too in this candle. So down here, we see that here the stop losses also got hit, and this zone really just got traded through because there is really much liquidity. And then what we again have here is that the structure is going to change. So we have down here the double bottom, which we got faked again because many traders are going to go short here and position themselves or put their stop loss over here again. And then our entry, because we re-entered the range up here, would be over here. So here would be our entry, here would be our stop number 1 or number 2. And then take profit number 1 would be here, or even up here if the market continues to go up. You can also use the trailing stop loss if you want. It's a thing that I do. So if the market really wants to go through this level, I am still in the trade, but if the market is going to do a reversal on the top, I'm going to get out. So because the probability is very high that it goes down or back to the middle compartment of the range. So, and I don't want to have a big trailing or a big drawdown getting in my trade, especially in prop trading my Apex account. So yeah, that's very important. So very important for you to know, we have to have very good auction quality, very good velocity to make the breakout. If the auction quality is bad, if there isn't much velocity going down, and if there's nothing interesting happening, then you don't have to think it's gonna do a breakout, because the probabilities are very low. So it's a thing that you can also learn. I will also show you in the next videos, but it's very easy to know if it's gonna be a breakout or not. So yeah, to again summarize this thing, we have here our structure which got broken up here. So our entry, if we look up into the footprint chart, should be some around here, because here many aggressive orders came in. So our stop is laying down here or down here. So this would be our trade, our stop loss, and our take profit would be up here. So up here. So again, a very good risk reward ratio. And as I told you, the hit rate are always around the 80%. So let's do a resume and let's look up what the strategy is all about. So the development of the strategy I created like 2 or 3 years ago, and since then it worked very well. I did 6 figures in payout in prop trading. I will also show you that. I will also show you how to get payouts live. So would be very nice from you to subscribe and to follow our journey here. So the target of our trades should always be the high of the range or the liquidity above it. So that results in a very high risk reward ratio and good hit rates, like I told you. And the 4 steps to make the trade happen is: number 1, find a range. conduct research to continually to improve. So do research or do market analysis and market replay trading to get even better in this strategy, because it takes a bit of time to really know where and when the trade is really gonna get good, because sometimes, like I told you, a range is not a good range, or the swing is not really the swing you want to see. So really become a professional in finding the range and finding the good range, the good swings, and do your research. So then the breakout. Wait until the top or the bottom zone is left or broken out, and observe what's gonna happen, and also look also in the order flow logically. So fake outs always have the attributes that we have a poor auction, no velocity, and not much going on really until we get under the prices we want to see. So now pay close attention to the market and what's it's doing. A fake could be created. And the entry, always use the swings at the guide, and pay attention to the swing that closes within the range. You can also use a tick chart if you need help. You can comment. I will show you how to install a tick chart. We use ATAS, so if you use ATAS too, I could help you there. So yeah, thanks for watching. Leave a subscribe or follow, and a like and comment would be very nice, because it's our second video, or my second video. Like I told you, I'm gonna do more videos. I just have to practice my English a bit also with these videos. But in Germany, we are very known for our prop trading payouts and strategies, and what we are gonna show you, you will see it's gonna be really interesting. So yeah, and also if you want to support us, we don't sell courses or nothing. So you can use code ALPHA if you want to use the strategy trading Apex Trader funding. So thank you very much guys for watching, and we will see you in the next video, which is coming up also in a very few days. Bye.